impact reigns. Impact is the point of what we're doing. And so if any one of the investments in our portfolio achieved financial success but didn't reach their impact targets, that would not be a success for us. And then the same is true when evaluating the portfolio overall. That said, when we evaluate potential investments, we are underwriting them to a very large scale potential impact. So could this technology, if it's fully adopted at full commercial scale, displace or avoid a gigaton of CO2 equivalent emissions by 2050 or more, right? So it needs to be able to believably take a big bite out of the problem for us to consider investing.
Hardware to Save a Planet explores the technical innovations that are giving us hope in the fight against climate change. Each episode focuses on a specific climate challenge and explores an emerging physical technology solution with the person bringing it into reality. I'm your host, Dylan Garrett. Hardware to Save a Planet is brought to you by Synapse. Make sure to click subscribe so you don't miss any future episodes. Thanks for listening. Hello and welcome to Hardware to Save a Planet. Today, I'm very happy to be here with Johanna Wolfson, a co-founder and general partner at Azolla Ventures. Azolla is a venture fund focused on investing in early-stage hardware companies that have the potential to reduce emissions at gigaton scale by 2050. Johanna and her team deploy catalytic capital to do this. This means they can support startups that could have massive positive impact on climate change and great financial returns, but they have a riskier path and longer payoff than many venture firms would be interested in. I think that's particularly important for hardware-based solutions that can have such a long and expensive path to commercialization. I have to say, Johanna has a very impressive track record in the climate tech space, with a particular focus on helping to smooth the path to commercialization for capital-intensive projects. Prior to founding Azolla, she had a role at the Department of Energy, helping to eliminate barriers preventing development of new energy technologies. She also did her PhD in physical chemistry at MIT, so she can go quite deep on the technical side as well. Today, she sits on the board of several companies I've admired from the outside in carbon removal, agriculture, and mining. I'm sure that is a ton of work, but it looks like a very fun job as well. Johanna, it's really awesome to have you here. Thanks for joining.
Thank you so much for having me. It's, looking forward to the conversation. And yes, I feel really lucky. It's an awesome job.
So yes, I definitely want to talk about catalytic capital. I think it's a term that gets used a lot and not defined very often in settings I've seen it. I am curious though, just to hear a bit about your background, because I loved kind of scrolling through your LinkedIn. It looks like you went super deep technically through your PhD. I read that you developed a spectroscopy technique to monitor irreversible photochemistry and photophysics in real time. And you worked on understanding far from equilibrium physics in the solid state. And I was like, wow, that sounds really cool. I have no idea what that is. You're welcome to describe that if you'd like. The question actually, though, is like, how do you go from such a technical background to this role pretty quickly, it seems like, in your career, to a place where you're focused on like improving the innovation ecosystem and eliminating barriers for innovators and connecting capital to founders, and now playing this very strategic kind of investor role and advisor role to all these companies? Like, that's not the typical path I see from such sort of technical founders or technical backgrounds. So I'm curious what that path was like for you.
Yeah, as these things often do, I think it feels very natural, to me, or in hindsight. But I did all the things that you described in graduate school, and that was my, there's a lot I loved about, being deep in the bowels of MIT, and like shooting lasers at stuff in the basement and doing the impressive words that you read from my thesis title or wherever you grabbed that from. But what I loved about it was, you're part of pushing forward the boundaries of science, which is to a scientist is just it's just a fundamental privilege and the most exciting thing you can do. But it didn't take me that long in the graduate school experience to start getting obsessed with a different question, which is, wow, what happens next after all this amazing stuff happens in the lab? And MIT is an especially interesting place that way because there are other places like it too, but it really does have that spirit of amazing science happening and things happening outside the walls of science, and people starting companies and going into industry and then coming back, and there's a lot of this cross-pollination. And so so I had kind of questions about what happens once something is published in a great journal, and I have to say I was kind of dissatisfied by the answers, including even at a place like MIT, which I think is relatively quite applied actually, and does pretty well, but just relative to the challenges that we need to meet, like it would be hard to argue that the scale and volume of exciting and important science is matching in any appreciable, rate or volume to the flow of ideas we need out into the market and making a difference in people's lives. So I became really obsessed with that exactly that question, and I said, well, that's kind of what I want to work on in my career. And I didn't know what that meant or what kind of job that was, but I knew that was the set of problems I wanted to go after. And so I did. And I guess this is the advice I give grad students is like, just if you kind of are interested in something, just go talk to as many people you can about that problem, and you'll start gaining vocabulary around how to describe it, and you'll start finding, people who work on it and therefore jobs that kind of touch on it, and you can kind of form your path. And so that's what I did, and had the privilege of starting to work with startup companies out of graduate school and through an industry applied lab, and then serving in the federal government for a tech commercialization role, and then coming to Prime, which is the nonprofit from which we spun out Azolla, and then founding Azolla. And the connecting thread through all those things is really understanding the barriers in the system for progressing, commercializing important technologies to market. Those barriers exist everywhere you look. I mean, there's capital barriers, there's policy barriers, there's just connectivity and network barriers, there's talent barriers, if you're in energy and climate, you're in many cases commercializing into incumbent industry. So there's challenges there. There's really, no shortage of places you could train a curious mind. But as I was leading the Department of Energy, I really wanted to work on the capital gap if there was a fundamentally new way to do that. And that's what led me to come on board and co-found Prime Impact Fund, which was our first fund and the predecessor of Azolla Ventures, which was really, hey, there's a different way of doing this. Venture is great and it has, its role, but it actually, there's a lot it can't do. And so what can we do to extend that model and bring a class of capital that isn't currently participating in getting new climate technologies to market? And that's what we've started to do. And that's Catalytic capital. So I never set out to, become an investor. I wanted to be part of an important new set of solutions to the commercialization challenge. And I'm really excited to be doing that in this forum today.
Yeah. I'd love to understand that in more detail. So what is it that, and maybe particularly about these kind of physical innovations for addressing climate change, what is it about the traditional venture model that isn't serving their needs? Or where is the gap?
It's a few things stacked on top of each other, and I would probably first go to just the combination of timelines and capital outlays. So it's expensive. As you know, you run this podcast, it's expensive to pay for hardware, right? It's just the capital outlays are going to be much more significant. So any investor looking kind of down the pipe of how many rounds of capital at what scale this company is probably going to need before they reach scale and therefore get some kind of exit, that's going to decrease the attractiveness in general of that investment. And then add to that in coordination with the capital outlays is the time duration. And traditionally, many venture funds are kind of 7 to 10 year durations. And so that means they're looking for returns on that timeline. And it's very hard to, commercialize. It's very unusual to commercialize a fundamental science and innovation that is encapsulated in a hardware technology and fully commercially scale it to its potential value in that time. And then one I mentioned earlier, which I think compounds this, but is less talked about, is we're not talking about creating new sectors here, right? So if you think back to kind of like some of like the advent of the biotech sector or the advent of, digital infrastructure, like that's work, that's sector creation. And there's kind of just so much value that can be built quickly because it's not displacing incumbents essentially, but in energy, ag, mining, all of those areas that you mentioned, there's someone else has been there already, right? And these are existing legacy sectors, and that creates a set of challenges, opportunities, yes, but also challenges in timeline to market because you have to work kind of within those sectors. And the difference between that and just expanding into total white space, I think, is actually very significant. So you add all that together, and I would say it's been maybe long agreed that traditional venture capital is not a good fit for most hardware for energy and climate. Now, the good news is that in the last 5 years plus, maybe plus and change, there's been quite a few entities, funds, voices, supporters kind of highlighting this problem, and in particular bringing funds to the market that have longer timeframes and can be more on the 20-year time horizon. And that's a good thing. That's what's needed. That's one thing that's needed, I would say. What we then bring that is stretching the envelope of what venture can do even further than that is that we're bringing tax exempt style capital to the front and investing that in an impact first, highly risk embracing way that lets us just take on disproportionate risk or go earlier than even what long time frame, climate oriented, impact oriented venture dollars might be willing to do. So it's all a continuum. None of this is really clean, clear, cut and dry boundaries, but hopefully that gives you a sense of kind of traditional venture and how limited that is, the expansion, the evolution of climate tech venture capital as an investing class within general, and understanding of those challenges and acceptance of them, and on average, longer timeframes. Although I will say that a somewhat troubling trend, I would say even in climate tech overall, is that these trends are understood, and yet it's very easy for climate funds to slip into software. Where are the software solutions? I mean, why wouldn't you, right?
Right.
So there's, I love the groups like Sightline and others who are really tracking funding flows because that lets us see the evolution of these things over time. But that's a bit about the continuum. And I will say that the climate tech investing landscape that we are participating in today is vastly more robust and, just fulsome than it was when we started investing in the 2016, 2017, 2018 timeframe. And that's a good thing. Even though there aren't that many funds like us, we do have a lot of partners out in the field that are deploying capital for climate. And that's great.
Yeah, you hit on kind of exactly one of the questions I had, which is like, how do you avoid the kind of just capitalist forces that say, look, yes, I understand these trends. I know this is the right thing for the planet long term to have this longer term outlook. But at the end of the day, I'll be more successful as an investor if I have more returns for my LPs and faster. And, that just feels like a really powerful pull towards shorter term thinking. And how do you avoid that?
So let me say, I think it is, and like you can see that trend in climate tech investing overall. There are two things that come to mind. One, which I think can apply in general to climate tech investors who have a particular interest or maybe mandate to focus on hardware, and then one that applies to us because of the structure of our fund. The first that could apply more generally is that at the end of the day, most venture investors should be looking for kind of the non-obvious opportunities. And so while I don't know that venture as an asset class is good at avoiding hype, it's clear that it should be good at avoiding hype. Like, that is the point. That if you're going into a hot area, you're probably too late. You've missed it. It stands to reason that for at least a minority of climate-oriented venture funds, that, it would be logical that, you could identify missed opportunities, maybe undervalued opportunities. If the majority of capital is going, say, AI-enabled whatever, energy efficiency, et cetera, that you might say, oh, well, that's actually undervaluing certain opportunities here. And you could surmise that those will be more so concentrated in the hardware landscape. So that's, again, on the continuum point, that gets you there a little bit. What's different for us is just structural. And so the whole premise of our operation is that a standard venture fund investing, standard dollars will always be pulled toward the forces that you said. And if you want to make different investments, you need to invest different dollars. And so the dollars that we invest think of them as they're like the grant dollars that a foundation would distribute out to an NGO or to, a policy kind of support organization. They are the type of dollar that would come from, a high net worth individual's donor advised fund that would be given to, any good cause. It is that type of tax exempt charitable capital that if you aggregate it, and this is what we've done, if you aggregate that, we are actually required by law, by the IRS, to invest that under two conditions. One is that there needs to be extraordinary impact potential. And two is that other investors in the market would not make the investment at that time. So there's almost like we almost do like an anti-investment evaluation, right? This has to be interesting, but not yet ready for other investors, or not sufficiently supported by other investors. There can be nuance to it, but the point is the type of capital that we've aggregated it's a different color of money, we call it. And that color of money has different requirements. And that is the answer to your question, is how do we avoid just falling into the same old traps? It's required by the type of capital that we're deploying. And that's what I find so awesome about what we're doing, is it's kind of exhilarating to have that type of different mandate and really to be able to execute on it because of the type of supporters that have put their trust in us and capital toward this, and go, find opportunities that could be extraordinary, but aren't yet supportable by mainstream VC. It feels like an incredible mandate to be able to carry out.
Got it. Yeah, that is a big difference. That is super cool. How do you measure success then? Like, what are your do you call them are they investors or are donors? But how, are they looking for anything in particular? Are you measuring purely based on impact, or is financial returns an important metric?
So I'll answer that a couple ways, but first and foremost, to be really clear about it, impact reigns. Impact is the point of what we're doing. And so if any one of the investments in our portfolio achieved financial success but didn't reach their impact targets, that would not be a success for us. And then the same is true when evaluating the portfolio overall. That said, when we evaluate potential investments, we are underwriting them to a very large scale potential impact. So could this technology, if it's fully adopted at full commercial scale, displace or avoid a gigaton of CO2 equivalent emissions by 2050 or more, right? So it needs to be able to believably take a big bite out of the problem for us to consider investing. And the truth of integrating into these sectors is that it is market forces that would enable such impact scale, right? And so it's logical that if a company does achieve gigaton scale impact, it is because they were able to leverage market forces to do so. In most cases, we don't see a trade-off there, but there is a difference in thinking because we say we are impact first, and we mean that on a few levels. Like literally, it is what we evaluate first, and then we see, if it could be a good investment or not, and then proceed if so. But also because it's, as you said, the way we kind of evaluate our own success. As we've evolved, we've built upon our model, and we actually now deploy a model of paired fund structure or blended fund structure, where we're able to deploy that catalytic type of capital early on in a company's life. And that's really the heart and soul of our investment strategy. And then we're able to draw on a pool of capital later on that is not catalytic or not tax exempt in nature, because it would follow on after a company has kind of graduated from that requirement of not being attractive to others. And so we follow on from this other pool. And then we zoom out and you look at the set of participants. You asked what do you call them, which is a good question. You look at the set of participants that's supporting this effort, which has both catalytic, philanthropic, tax exempt, just highly risk embracing capital, as well as impact aligned, but more explicitly money making capital from endowments or family offices or whatever. You look at that whole envelope, and it is the widest spread you can imagine. There's folks who gave just a donation, and there are folks who made what's called a recoverable grant, but with philanthropic dollars. And so if our fund does well, those dollars will go back, but they stay charitable in nature and they get to be given in multiples to some other good cause. We also have folks on the what we call the full cycle side, the non-catalytic side, that are doing this as part of their venture set of their portfolio, with the intent to make money off of it. But they're impact aligned. Otherwise, they probably wouldn't be, in our longer term fund for climate. They would probably be doing something else. And so it's quite a variant, but we are pretty intentional and consistent in we're not telling two different stories. We're not telling, the folks, the philanthropic folks that, it's impact, and the other folks, it's about the returns, and it's good if we do we're not that smart. We can't keep track of two different stories. It is impact. Impact is the goal. And that is the proposition that we're giving partners, no matter what type of capital that they're showing up with.
But your point, you likely won't have impact at scale without financial success. Yeah, because it's market forces that will drive that. Yeah. How do you make money as a firm? Is it a typical kind of management fee and carry?
Yep, pretty typical structure. And that's actually an interesting point. We experimented a little bit with our very first fund with some modifications to that structure. Because we're an impact fund, and that actually wasn't attractive to LPs out in the market. They're like, just make it, you're already doing something unusual. Don't add things that are unusual. Don't be too different. So yeah, point taken.
I don't know if this is an easy or hard question, but it does make me, I have heard some voices arguing that we shouldn't be putting resources towards these long-term risky things like climate change is a now problem. We have solar, we have batteries, we have wind, we have EVs, just put all of our resources into scaling the low risk technologies that work today. Focus on the high risk things that are going to work tomorrow in the long run. Can you say something about why you believe that's important?
Absolutely. And this is sometimes couched as the development versus deployment debate. We've got everything we need, just go, go, go on the deployment side versus, no, we need to develop more. And to give the probably trite answer, we definitely need both. And I think that there's more between those two modalities than might first meet the eye. You mentioned wind and solar, but let's take geothermal as an example, near and dear to my heart. Do we have geothermal? Yes. Is it affordable enough to scale to, be what it could be and, be one of the cheapest forms of clean, firm power on the planet? No, not yet. We need innovation to do that. And so even that dichotomy, I think, breaks down pretty quickly if you take an example, but I still appreciate the discussion because look, there are real asset allocation decisions that are being made, and a dollar can go to either a development project or a research project or a deployment project. So I appreciate the need to discuss it. One of the analyses that I've found really helpful in thinking through this is the IEA, as one example, has kind of a breakdown of the scalability of different technologies to meet the climate goals, and their estimate, and it bounces around every couple of years when there's a new report, but their estimate generally goes between, 20 to 30% of emissions that we need to be avoiding by the 2040 plus timeframe. More likely than not, based on, policy expectations, which of course support or hinder those deployments that we're talking about and assuming can just roll forward. More likely than not, 20 to 30% of needed avoided emissions will come from technologies that are not yet commercially available today or commercially economic today. To me, it's thrilling news that it's not a bigger number than 20 to 30, because that would be quite concerning. And how can we meet that? But that's quite a big chunk. And if we don't know where those emissions savings will come from, then we need to be working on lots of different solutions. And we're kind of the folks who are doing the kind of biggest bank shot approaches there. And the reason that this mission, to me, becomes only more important as time marches on. I mean, you could argue the closer you creep to 2050, like, forget that research stuff, deploy. The deployment pace just has not met projections, period. I mean, they've fallen, solar, wind, others have fallen very far short. And so it sort of increases the load requirements on future, not yet commercially available technologies in the out years. And I don't hear a lot of folks talking about that, but that feels like very true. That, one could assume that deployment targets will continue to be missed. And if that's the case, that we actually, we're going to need more. We're going to rest more on the technologies that are being developed today than even we know. Unfortunately.
Do you have an example of a company that kind of exemplifies, what's possible with your approach that wouldn't have been supported by, traditional funding, and that kind of represents these bigger long-term risky bets?
Yeah, I have a lot that I could choose from, since our portfolio is, made up of those. But maybe one that I'll pull out because it's a really non-obvious one. I mean, there are companies I could talk to that I think are, like Sublime has been on your podcast before. That's a good example of a company that we supported. But one that I'll spend more time on is C-Motive. It's a motor company based in Wisconsin, which is developing an electrostatic motor platform that essentially leverages the electrostatic force instead of the electromagnetic force. And the benefit of doing so is that you can have very high torque and very high efficiencies. And so instead of sending electricity through copper windings and creating the magnetic field that spins the motor that way, which creates a ton of loss through all these lossy copper windings, you actually have extremely minimal loss. And so instead of something like 60% efficient, a motor can be upwards of 90% efficient. And motors are one of those sort of like just hidden realities of the universe in terms of how ubiquitous they are and truly how little we think about it. And so if you were able to think about even displacing, something like 10% of, motors for which this would be a good fit, the impact is actually enormous, but it's totally hidden. I love this example because motors, arguably not that sexy, really early stage technology, spinning out of the University of Wisconsin, which is actually a motor mecca in terms of the academic, work being done on innovative motor platforms, but not a center hotbed of venture activity. And so you put those two things together. Back several years ago, C-Motive wasn't really on the radar of Bay Area or Boston-based VCs. And yet we saw this enormous potential in terms of the invisible savings, right? And that's exactly the kind of problem that we should be going after, because it's not going to be sufficiently supported without that kind of elevation. And so, from 2019 or 2020, started supporting this company and really worked on the narrative, team building, patient technology development, commercial development. And fast forward to today, they've, raised 2 additional rounds of funding, including most recently, well, actually, this isn't public yet, so I probably shouldn't say anything about that. So scratch that. But they raised, 2 additional rounds of funding, very well capitalized at this point, and have their motor operating at some, tier one customers that you would know. And it's just such an exciting thing because it's I think they got a lot of feedback that, this isn't really that interesting of a play or this or that from VCs who are kind of chasing that hot story. But the customers are showing up and responding and saying, yeah, I need that. When can you make 500 of them? And so that ability to kind of just ignore or quiet or pause the kind of like, I'm not sure this is hot enough, and see the opportunity for what it is, both from the impact and commercial standpoint, and kind of move anyway, and then slowly build, a syndicate and coalition around it, which is what we did. That's kind of the power of this platform.
So one thing I hear a lot these days is like a lot of uncertainty about the future and all the challenges of being a climate tech company right now, with all the kind of changes in that are coming from the current administration. I'm curious what your take is. Like, how have things changed, since January?
Yeah.
And what should we be doing about that?
How long do we have? Okay. One thing that's interesting is that it does depend on the subsector. If you're a mining and materials recovery company, you might be feeling a little bit better than an offshore wind company right now. There's kind of certain categories in favor, certain categories out of favor kind of thing going on. But in terms of what's different, I guess a few things. One is many companies are, having to just reevaluate, recalibrate. Some of them had very large government projects lined up. Not everyone, but for those that did, that's a pretty big recalibration moment. And obviously navigating that's probably the most obvious one. But secondly, there are companies that are thinking about, okay, what's coming down the pipe in terms of the reconciliation bill at the end of August, and what's going to happen to the tax credits. Now, happily, I think we don't tend to underwrite investments with any subsidy. Companies need to have freestanding, strong economics to receive an investment from us. And many other climate tech funds I know espouse that same principle for the very clear reason that has been demonstrated is you can't rely on that stuff. It's not a good idea to build a business that doesn't have foundationally strong economics. That's relatively harmless statement. It should be anyway. But there are definitely companies, I know out there who are depending, or maybe their business case was built on tax credits, and that's a tough place to be in right now. There are companies for whom, the tariffs are a real concern, kind of bit of a wait and see approach, but supply chains starting to be affected for sure. And we're also noticing companies, especially in carbon removal and areas that might have been hoping for compliance market in the US, just kind of going abroad and looking for opportunities in Europe in particular, but also West Asia, Latin America. I mean, we often think about the US as the center of the world. Well, that's not the case, especially not in climate policy right now and climate, market. We do see a lot of companies looking for and finding promising opportunities elsewhere. The other impact that we see is really just indirect, and it's the climate tech venture community responding or preparing to respond, right, to changing dynamics in the market. And so, unfortunately, there's there's already unfolding and likely to continue to unfold, quite a pullback in certain areas of climate investing that are out of favor politically. And one-to-one, those shouldn't map, but I see the impacts because, folks are worried about what have we not thought about, what headwinds might come for these companies down the road. The market conditions are concerning. I think I'm going to hold back in my portfolio or hold back capital for my existing portfolio rather than making new investments. Those types of kind of conservatism in just deploying capital, those come out. And we're certainly seeing that already in terms of kind of the temperature of the market as companies are, out raising or, speaking with investors.
That's kind of the vibe I hear from people fundraising. Is there any advice that would be useful for folks in that position right now?
Have a backup plan for the round to be smaller than you think. In other words, think about a use of funds that can still get you to a valuable inflection milestone or set of inflection milestones on less capital. Plan out for longer runways, right? So if you were planning on, if you were running down an 18-month runway that is set to expire at the end of this year, revisit your plan and see, what would you change today if you knew that you had to get another, 6, 12, or 18 months of runway? Because if you wait until then, it's too late. You didn't make the adjustments. So a lot of the companies that I'm working with, we're going through that scenario planning just as a plan to have. It's just smart to have a plan. I mentioned this earlier, but we definitely are seeing success in looking abroad at deployment opportunities in particular, and kind of customer pilots and demonstrations. And so if a company isn't doing that, but feels affected by the market dynamics in the US, they absolutely should be doing that. And they might see more uptake there, which could have a quite different effect on their financing, because that's directive. Customer engagement speaks, and that speaks louder than anything else.
Are there any sectors or, I don't know, categories of solutions that you are looking for or would like to see more of?
There's a long list, but I'll try to limit it to focus on one area as an example, and that is kind of the super polluters or the very high global warming potential greenhouse gases like methane and nitrous oxide. This is, for me, a very logical area that we at Azolla would push into as what I'll call more traditional mitigation approaches, like electrifying industrial operations or, clean, firm baseload power. As those increasingly areas, I think, mature and, see more mainstream climate investment. It's not to say that there's never, a need or opportunity for us there. Absolutely, there can be. But in the main, those areas are maturing and I think seeing more support. And when we talked earlier about kind of like the climate projections and, the march toward 2050 and beyond, and how we're not doing so well against those projections and what we said we needed to do. The biggest lever we have is going to mitigate near-term warming, is to go after very high global warming potential greenhouse gases. Those are nitrous oxide and methane are the two biggest ones by if you cross volume and the global warming potential of them. Their impact is just enormous. And so finding opportunities to draw those down is extremely urgent. But the kind of nascent markets to support the drawdown of those greenhouse gases is nascent, doesn't even begin to describe it. I would describe CO2 removal market as nascent, but the removal market for methane and nitrous oxide is virtually non-existent. And
like the voluntary credit purchase market.
Exactly. The methodologies for, having those apply. And so that is a set of problems that, for those who, would say they prioritize climate impact first and foremost, that is an urgent set of problems staring us in the face. And an area that I'm very interested in. We actually made an investment in a company called Biolumic, which is doing photomorphogenesis for plants. That means that they found a way to have plants, seeds actually, respond almost epigenetically to light exposure. And that leads to certain trait expressions in crops. Well, they're starting to commercialize that in row crops, but we invested because we're really excited about the potential of that same technology and mechanism in reducing methane sources, both in rice paddies. If you can make the rice seedlings stronger and more vigorous, the farmers wouldn't need to flood the paddies, which is what leads to huge methane off-gassing. And similarly, if you can actually modify the lipid content of ryegrass, which is what pasture-fed cows primarily eat, they actually emit less methane. And so there are these amazing levers, right, that if we're able to prove them out and commercialize those in the form of products, could make a big dent. So that's just one example. Or other, kind of methane, we call them methane moonshots that we're going after. And then the other area that I'll mention that I think is, we're going to be leaning into more and more, and then we'll need to find a way to, and this not on such a depressing note, is adaptation and resilience, because we're already, frankly, in a state of pretty severe climate impact for many people, properties, geographies, and it's only going to get worse. And so, and that's true, even at this point, if we were to meet our climate goals, there's this concept called overshoot, which is, that because of sort of the time lag of what we haven't done to date, we're likely to be overshooting past the 2-degree mark, and that's going to have quite significant, human, economic, property, ecosystem implications. And so we at Azolla are now also expanding our scope to be supporting solutions that are in service of adaptation and resilience. Even though our primary thrust is still on climate change mitigation, it's impossible to ignore that so far, collectively, we as a society have not succeeded at that. And so we need to be, helping the effects of that in the meantime. So those are the two areas that I would, draw attention on as kind of forward-looking areas.
That's interesting because you don't measure that in terms of CO2 equivalent emissions reduction, right?
No, you don't. Yeah, you measure other things. You measure various attributes of ecosystem preservation. You measure human lives affected and to what degree. And it's definitely a harder impact projection problem for sure. So yes, you are tapped right onto it.
Looking into the future a bit more, what's your vision for the future of Azolla? What kind of impact do you think you can have as a firm? How might things evolve for you in the future? What does that look like?
Thank you so much for asking that question, because my partners and I absolutely love to think about that. Two things come to mind. One is what I hope we are able to do with Azolla proper. And secondly, what I hope, Azolla enables and inspires outside of our organization. The platform that we are building to really welcome in this special catalytic capital that is so powerful, it can do things no other type of capital can or will do. And it can do that with smaller dollar amounts when paired with, more conventional dollars. That is such a powerful concept. And I think we think of Azolla as a platform for doing that towards whatever problems are most needed. Now we will stay focused in climate, right? I'll get to beyond climate when I get to beyond Azolla. But even within climate, there are different ways you could imagine that problem or that tool set being deployed. You could imagine, focusing on the global South. Imagine a vehicle focused exclusively on, adaptation and resilience, or mitigating the impact of migration on communities, or any number of things. You could also imagine it being slated to address different capital gaps. We address in general the very early stage venture capital gap, but there are later stage capital gaps as well. There are folks working on that, but the role of catalytic capital could actually be quite broad in terms of where you point it. My hope is that by using Azolla as a platform to really point this very powerful, type of dollar at where it is most needed, that will be able to catalyze, a lot of really critical solutions that wouldn't have otherwise gotten off the ground. And that's what is very gratifying, is that because that is built into our thesis, that additionality idea, we have some confidence that we're making, something meaningful happen that wouldn't have otherwise. Outside of Azolla, I hope that, this model is picked up by others and, is within climate and outside of climate. I think philanthropy in general and catalytic capital, a lot of philanthropists are very just hungry to make the absolute biggest impact that they could have, and, innovate in philanthropy and explore different ways of supporting, causes that they care about. And so this as a model actually could be quite powerful beyond our firm. And we very much hope that happens.
Okay. I have 3 final questions for you. The first is, how optimistic or pessimistic are you about the future of the planet, and why?
I'm pretty pessimistic. I am optimistic about the power of entrepreneurs and founders and technology and new solutions to bring things to bear that we might not have previously imagined. So that's always the X factor, which is why I'm in this job. But the pessimism, what's driving, so it's not that. What drives my pessimism is that I think even we as a climate community we're not having the hardest version of the real conversation about how far off we are from our goals, because there's a desire to project optimism. And that's the reason why I need to answer your question the way that I do, is because I think there's actually a strong pull to say, no, I'm optimistic. And I actually think that's harming us in the long run.
Yeah, I appreciate that we often get an optimistic answer.
Yeah. Do you usually get an optimistic answer?
Yeah. So, I think, what you're saying makes total sense.
Mm-hmm.
I think it's an important part of the conversation. Who is another company or individual doing something to address climate change that's inspiring you? You've already given a couple of good examples.
This is a new effort. It's called the Arete Glacier Initiative. It's run by a professor out of MIT, Brent Minshew, and it's essentially about, glacier engineering that we might need to do to avoid extreme passage of tipping points and, that realm of things. And so you can see what I'm doing. I'm raising this because I don't think that we're all talking about this enough. And so I am pulled to highlight someone like him and an effort like that because it is not getting the attention that it deserves.
I'll look it up.
Yeah, look it up. It's awesome. It's quite new. And I just sat in on a couple info sessions the organization did, like super educational, a little bit, horrifying and alarming to learn more about the situation that we're hurtling towards, but important and just highly educational. And I'm just so, there are a couple funders out there who are supporting, increasingly supporting initiatives like this that I think are, may end up being exactly what we need.
What advice do you have for someone not working in climate today who wants to do something to help?
Leave your job and come work in climate. We need you.
All right. I'll take it.
But there's, every company that I work with is so, can always benefit from, additional talent and enthusiasm. And the universe of, I guess, climate professionals has just expanded so much. And I think, that like the networks available to kind of find your piece of it and find your pathway have, I think, really exploded in the last few years. And I think that's really exciting for someone who wants to break into the space or, grow into it over time. That would have been great. But if that had existed for me. So I would definitely encourage people to take advantage of that.
Awesome. Johanna, that was really fun. Thank you very much for your time.
Thank you. That was nice.
Hardware to Save a Planet is brought to you by Synapse. To find out more about us and how we develop hardware solutions for the world's most ambitious companies, head to synapse.com. And then make sure to search for Hardware to Save a Planet in Apple Podcasts, Spotify, or anywhere you like to listen. Make sure to click subscribe so you don't miss any future episodes. On behalf of the team here at Synapse, thanks for listening.